This video tutorial focuses on SSEG tariff design. Please refer to video 1 for an introduction to the model and video 2 for a detailed tutorial of entering data into the model and interpreting the results. We strongly suggest that you watch those videos before watching this one. I'll start by defining SSEG tariffs. It is assumed that people will only want to install solar PV if it makes financial sense for them to do so. For this reason, compensation mechanisms are often used to incentivize the installation of solar PV systems. A compensation mechanism is an instrument designed to reward the solar PV customer for any generation exported to the electricity grid. Compensation mechanisms matter because they influence the value proposition of a solar PV investment for individual customers. In other words, compensation mechanisms influence the customer's business case. Important components of any compensation mechanism include the contract length, which is the length of time a customer is locked into an agreement. If the contract length is short, example 1 year, this adds to the riskiness of the investment, as the municipality could change the prices. The crediting terms, which define when a customer pays and how the bill is determined, and the system caps, which indicate how much electricity can be exported onto the grid. There are no universally accepted definitions of the many types of SSEG tariffs that exist. Some examples include net metering tariffs, net billing tariffs, net feed-in tariffs, and gross feed-in tariffs. For the purposes of the model, the user is able to choose from a number of predefined options in order to best fit their SSEG tariff design to the model. These options are time of use or flat tariffs, where the credit balances can be cleared every month or rolled forward and only cleared at the end of the year, whether the municipality can pay customers for credit balances, and whether the export tariff changes over time or is fixed. Here are 2 examples of how SSEG tariffs can be defined in the model: net billing and net feed-in tariffs. Under net billing, customers with SSEG receive credits for excess electricity exported to the grid, when the electricity produced exceeds the electricity consumed. Consumption costs and export credits are offset against each other for each time of use period. The monthly balance is rolled forward over from month to month so that if exports exceed imports in a particular month, that benefit is shifted to the next month. At the end of the year, the variable component of the bill equals the sum of the 3 time of use periods. If the total is negative, it is set equal to 0 in calculating the bill. The export tariff increases over time, and a single bidirectional meter is needed to measure both energy usage and any exports. For a net feed-in tariff, the same calculation is done, but payments can be made from the municipality to the customer if exports exceed imports. So the variable component of the bill is not set equal to 0 in calculating the bill. Also, a net feed-in tariff scheme typically guarantees SSEG customers specified payments per unit over a fixed period, normally around 20 years. In other words, the export tariff may be fixed for a 20-year period. As with net billing, a single bidirectional meter is needed to measure both energy usage and energy exports under a net feed-in tariff scheme. Now we will look at the difference between a standard consumption tariff and an SSEG tariff. A standard consumption tariff includes the following elements: the network cost, which includes costs associated with operating and maintaining the network. Network costs should be charged to all customers and should be the same for SSEG and non-SSEG customers. If network costs for SSEG customers, for example, are higher, this could incentivize solar PV installations. The service charge, which includes costs associated with providing a retail service network, for example, metering and billing. A service charge is normally a daily rate and is charged monthly. All customers should pay a service charge. And lastly, the energy charge, which covers the total cost of electricity purchased from Eskom and includes a margin. The network cost and service charge are fixed regardless of consumption, and the energy charge changes with consumption. An SSEG tariff includes the same elements as a standard consumption tariff, with the addition of an export tariff in the variable charges. An export tariff is a payment made to a customer for every kilowatt hour of surplus electricity a customer's solar PV system exports to the grid. Now we discuss some of the best practices for SSEG tariff design process. These include 1. Carrying out a cost of supply study. A cost of supply study should be carried out prior to the developing of new tariffs. The study will determine the true, fixed, and variable costs of supplying electricity to customers. 2. An export tariff should be introduced. All customers should be able to be on an SSEG tariff, and SSEG tariffs should be designed in such a way that customers cannot reduce their bill simply by switching onto that tariff, without making any changes to self-consumption or generation. 3. A duration for the payment of export tariffs should be set. In South Africa, there is currently no guaranteed period for continued payment of feed-in tariffs. This is an added risk faced by SSEG customers, as many rely on the feed-in tariff to create a financially feasible business case. This risk can be lessened by ensuring that the payment system will not end before the SSEG customer has had a chance to recover their investment. 4. Possibly introduce time of use metering for SSEG. A time of use tariff may be more cost reflective than a flat tariff or two-part tariff, as it accounts for the varying costs of generating and supplying electricity during different hours of the day. 5. Ensure grid connections remain the most appealing options. Decisions regarding SSEG tariffs should ensure that remaining grid-tied is the most appealing option in comparison to off-grid alternatives, both financially and in terms of security of supply. 6. Economically optimized PV installations should be promoted. Systems with a low levelized cost of electricity, calculated by accounting for all of a system's expected lifetime costs divided by the system's lifetime expected power output. 7. Transparency of tariffs should be ensured. The introduction of SSEG tariffs should be done with some degree of consumer engagement. 8. Accurate customer load profiles should be developed. Representative high-resolution load profiles should be generated using a sample of high-resolution consumer demand data collected over a period of time. And 9. Revenue protection and customer SSEG financial returns should both be considered when setting SSEG tariffs. If customer SSEG financial return needs are not considered adequately, it will impact on the municipality as it increases the number of unofficial connections with associated power, quality, and safety concerns, and reduces municipal revenue as unofficial customers often simply allow their meters to reverse when generation exceeds demand.
The next part of the video covers using the model to assist with SSEG tariff design. I will go through two examples in this video. The first is for residential customers and the second for large business customers. We will need to move between three sheets in this video. The first is the standard model inputs, the second is the principal report, and the third is an additional sheet in the workbook which I inserted and labeled SSEG tariff design. Remember that this sheet isn't part of the model. Let's now do the first example, which is for residential customers. The inputs used for this example are shown on this slide. The municipal tariff is an IBT tariff with energy charges as follows. Between 0 and 100 kilowatt hours, a charge of 130 cents. Between 101 and 400 kilowatt hours, the charge is 152 cents. Between 401 and 650 kilowatt hours, the charge is 166 cents. And for consumption greater than 651 kilowatt hours, the charge is 179 cents. This equates to an average tariff of 146 cents per kilowatt hour. The total amount of electricity supplied to this group of 438,425 customers that are on the relevant municipal tariff was approximately 2.4 billion kilowatt hours per annum. The PV installation size is 2 kilowatt peaks at a cost of 22,000 Rand per kilowatt peak. For completeness, the Eskom bulk power purchase tariff and technical loss percentage are also shown on this slide. We will test 3 sets of SSEG tariffs, which for convenience are shown on this slide. Option 1 is a fixed charge of 150 Rand per month, an energy charge of 150 cents per kilowatt hour, and a feed-in tariff of 83 cents per kilowatt hour. These charges are the same in summer and winter. Option 2 is a fixed charge of 50 Rand per month, an energy charge of 150 cents per kilowatt hour, and a feed-in tariff of 83 cents per kilowatt hour. Option 3 is a fixed charge of 150 Rand per month, an energy charge of 150 cents per kilowatt hour, and a feed-in tariff of 150 cents per kilowatt hour. With residential customers, the main elements of tariff design to consider are the export tariff, as exports are likely to happen, and the fixed charge, which will protect the loss of revenue due to reduced sales. This is why we have chosen the relevant examples. Now, let's go to the model. Note that in this example we have chosen annual clearing. No payments can be made to the municipality to the customer, and the tariff can change over time. This corresponds to a net billing tariff. The first option is already entered, and if we go to the printable report, we can see the results. For the purposes of this video, I am looking at tables 2 and 4 and chart 2. I've already copied and pasted these results into an extra sheet so that I can compare them later. Now I'm going to change the SSEG tariffs to reflect option 2. And look at the results in the printable report. Here they are duplicated in the extra sheet. And now I'm going to change the SSEG tariffs again to reflect option 3. And look at the results in the printable report. Here they are duplicated in the extra sheet. Once results for various SSEG tariff options have been generated, then these results can be compared to determine the best SSEG tariffs for the municipality. It is important to look at the revenue impact results and the business case results together in order to try and generate a win-win situation for both the municipality and the customer. Note that in these examples, self-consumption doesn't change between the three scenarios. In this example, we can see that the best result for the municipality, option 1, is also the least favorable result for the customer in terms of the business case metrics. And the most favorable result for the customer, option 2, is the least favorable result for the municipality, even though the revenue decrease is very small. However, it is up to the user to interpret the results, and this is why tariff design is part art and part science. Let's move to the second example, which is for large business customers. The inputs used for this example are shown on this slide. The municipal tariff is a time of use tariff with a fixed monthly charge of 1,886 Rand per month and a monthly demand charge of 156 Rand per kVA, which is the same in summer and winter. In summer, the energy charges are as follows. Peak is 120 cents per kilowatt hour, standard is 74 cents per kilowatt hour, and off-peak is 52 cents per kilowatt hour. In winter, the energy charges are as follows. Peak is 313 cents, standard is 114 cents, and off-peak is 61 cents. The total amount of electricity supplied to this group of 1,013 customers that are on the relevant municipal tariff was approximately 3.3 billion kilowatt hours per annum. The PV installation size is 200 kilowatt peak at a cost of 15,000 Rand per kilowatt peak. For completeness, the Eskom bulk power purchase tariff and technical loss percentage are also shown on this slide. An example of a typical large business customer is a shopping mall with a constant load. The load profile for this typical customer is shown on this slide. We will test 3 sets of tariffs, which are shown on this slide. These tariffs consist of a fixed charge, a demand charge, time of use consumption tariffs, and an export tariff. The summer and winter tariffs differ. I will now point out the differences between the tariffs. Option 2 is the same as option 1, except the export tariff decreases to 65 cents per kilowatt hour. And option 3 is the same as option 1, except that there is no demand charge. With commercial customers, the main elements of tariff design to consider are the demand and fixed charges, because there is generally little electricity that is fed back to the grid. Also, with commercial customers, the municipality's margin on the energy charge is a lot lower than with residential customers. Thus, the municipality is dependent on the fixed and demand charges for the majority of their revenue from these customers. As a result, the effects of the reduced sales volume on the municipality is not as significant as with residential customers. Now let's go to the model. Note that in this example, as with the residential example, we have chosen annual clearing. No payments can be made by the municipality to the customer, and the tariff can change over time. The first tariff option is already entered, and if we go to the printable report, we can see the results. Once again, for the purposes of this video, I'm looking at tables 2 and 4 and chart 2. I've already copied and pasted these results into an extra sheet so that I can compare them later. Now I'm going to change the SSEG tariffs to reflect option 2. and look at the results in the principal report. Here they are duplicated in this extra sheet. You will notice that the results are the same as for option 1, as large customers consume all electricity produced on site in this example. And now I'm going to change the SSEG tariffs again to reflect option 3. And I'll look at the results in the principal report. Here they are duplicated in this extra sheet. Now, it is up to the user to compare the results. In this case, I'd suggest doing some additional examples as well. But these 3 examples reveal that in order to protect its revenue, the municipality should have a reasonable demand charge as well as fixed charges in place, as in option 1 and 2. And because there are no exports in this particular scenario, the level of the export tariff does not matter. The reason that there are no exports would be because of the size of the PV installation versus demand, as well as the load usage profiles. It is interesting to look at the load usage profiles for residential and large business customers, which can be found in the model. And that brings us to the end of this section on SACG tariff design. We hope that you have found it useful.
Hi again, I'm Nkolo Masalela from Genesis, and on behalf of the team, I'd like to thank you for watching our SSEG training series on the GIZ SALGA SSEG Financial Impact Model. We hope that you found these videos instructive and easy to understand. To recap, the first video provides an overview of the model. We take you through the various tabs in the model and provide an explanation of each tab. We also introduce the user guidelines accompanying the model. The second video focuses on entering data into the model by guiding you through the standard model inputs and advanced model inputs tabs, and also interpreting the results by examining the printable report. Lastly, the third video focuses on using the model to assist with SSEG tariff design. We define SSEG tariffs, illustrate the difference between a standard consumption tariff and an SSEG tariff, outline best practice for the SSEG tariff design process, and go through examples of the calculation of bills for different types of customers. Should you require further assistance or support in using the SSEG financial impact model, please feel free to contact SALGA or GIZ. Contact details will be provided in the closing slide. Thank you. The SSEG tariff model, guidelines, and presentation are all available online and can be accessed using the links presented on this slide. Thank you to Sustainable Energy Africa and City of Tshwane for making the City of Tshwane Revenue Report available as a reference, which can also be accessed online. Should you require further support in using the model, please contact any of the following persons. Thank you.